Welcome everybody to our another episode of Deal Winners AMA. Today we have a very special guest, Daryl Walker, and he has a really awesome and a new kind of way to partner to get deals. So we'll be talking about him and his method of acquiring deals in a little bit. For now, let's get started. Okay, so our weekly class every Friday where we talk about deal finding, financing, and the mortgage arbitrage process. Scan this QR code if you want to join the class. And we have a buyers list. We started building a buyers list for the deals that that comes across our table, and just a couple of deals to show you of the deals that we were able to move. We moved a couple of sub 2 deals and cash offers. This is a 20-acre property in a opportunity zone. It just got sold, and we're actually looking at using that to develop it. This is a property by Mart, Texas, which is about 20 minutes from Waco. Really exciting area. The fact that it's an opportunity zone, which means that in general, if you have a capital gain on some other investments, you can put it into the opportunity zone, and you'll be able to gain some tax advantage depending on how long you leave the money inside the opportunity zone for those capital gains. So really excited. We also have a live deal right now in Greenville. You can see that it's still kind of in construction. This is a duplex. Half of it is kind of livable, just needs finishing out, and the other half of the duplex will need to get built out. So we have a really good purchase price, obviously a little bit bigger rehab, but we see it as a pretty good deal. It's about 65% ARV minus repair. So let's get started. Daryl, welcome. So let's welcome Daryl to stage here. Hey, good to see you. Thanks for joining us.
Hi, Steve. Hi, everyone. Thanks very much for having me on your Deal Winners AMA. I hope everyone's doing well.
Yeah, and happy holidays.
Indeed, same to you. Yeah, busy time of year for sure. But yeah,
Yes,
lots of cool stuff going on.
So Daryl has been winning a lot of deals. He's built a 3 million plus portfolio of multifamily and single family properties. And when he shared with us his success story, he shared that he has over $1 million in deal revenue, and he's expecting 10 to 15% profit margin. And Daryl, I thought your model of acquiring deals through partnership and funding, that was a very interesting model. And so we would love for you to kind of tell us a little more about that.
Sure. No, Steve, thanks so much. And yeah, I mean, maybe just a little bit about myself and why, how that leads me to get to these type of deals. But
I think, tell us your story.
Yeah, no, I mean, look, I'm a family man, happily married, very blessed, 4 wonderful kids. And so that drives a lot of, kind of my mindset and methodology. And I think integrity is, really very important to me as well. But from there, you kind of get into this whole concept of partnerships, and we can do a lot more when we work together and when we collaborate. So I really try to make that kind of foundational for anything I do, not just in life, but specifically in real estate transactions. This is such a massive sector, as we very well know. And Steve, you guys are leading the way in terms of data. We count in the trillions when we talk real estate. So it's such a massive sector that we can leverage our own skill sets and our own opportunities when we do partner. So that's a big thing for me. Although obviously I want to get a good return for the value I create. I truly believe that working in partnership is the best way. And then I suppose, that another kind of grounding value or tenant, if you will, is I believe very much in using technology and data, and as an entry point, and finding deals, assessing deals. Everyone can run numbers, that's great, but can you do it at scale, and can you do it fast, and can you do it with confidence? And that's where I think, combining sources of data and the technology to use those, be it a CRM workflow, or be it algorithms to underwrite, rapidly. These are all approaches that I think it's important that a real estate investor today is on top of, so they can be competitive.
Yeah, absolutely. I find that so I have joined the industry about 10 years ago, over 10 years now, and to be honest, Daryl, I find that we're still kind of lagging in terms of
Yeah.
technology adoption, which in a way it's also good news for us investors, because when we come in, we can really leverage the technology that's already built out and proven, and use it to, for whether it's deal finding or underwriting or other aspects of our investment journey.
Fully agree. And just a little, maybe a bit of a small story just to underline that. Actually, my very first real estate transaction, a bit of a funny story. I also work in oil and gas. So prior to moving to the US in 2022, I'd been all around West Africa and Europe. So the very first real estate transaction I closed as an investor was from Lagos, Nigeria. And I can tell you, it was complicated getting a lender and getting a title company to go through the transaction with a British investor calling from Lagos, Nigeria. But anyway, we got it done. That's probably the topic for another call. But really, my entry point was very much on, I decided on a state, I decided on Texas, I decided on a kind of price range, and then from there it was very much looking at the different metro areas and saying where I felt I could get the best return for my capital. And it led me to I would say a hidden gem, but an opportunity for a somewhat stabilized but a fourplex that was way below market, and all of the other metrics were just so much more advantageous for a cash investor versus what else I could see. And I'd been assessing hundreds of opportunities, and really that I jumped in on that, moved in, was able to negotiate a good price, and from there it was really kind of off to the races. But the reason I mention this is we need to, no seasoned investor is going to advise move out of the Dallas, Houston, stick with the big markets, but do not overlook a good opportunity, a hidden gem that may exist out there. And that's really where, if you use data that are available, if you use some of the simple technologies out there to assess and understand where the opportunities are, you can pick up some hidden gems. So that was a platform for me, at least, to increase rents, increase cash flow, take some bonus depreciation from the asset, bring my taxable income down last year, and then I just recently exited with a really healthy return. So very, very important that today's investor is leveraging all of the information that's out there as best you can.
Yeah. We talk about information, Daryl, and so when you start looking at and analyzing the deals, what would be some of the advice you would give to our audience? What would you do to to do analyzing and making sure it's a good deal?
Yeah, I mean, there's obviously some basics, aren't there? Sort of, the market that the property's in, jobs, infrastructure, household income, all of these kind of macro, you could say, or macro for the region, external factors. And not to get too bogged down into these numbers as well. I think it's important, there's this phrase of paralysis by analysis. So it can be quite easy to get bogged down. But you need to have that basic understanding, and that can also be a go no go, I could say, for some opportunities. If you just, if you don't like the market, or you don't like the direction it's going, then look elsewhere. But thereafter, really, it's understanding how the individual property or the individual asset sits versus its, the region you're looking in. Is it sort of above, below, the mean in terms of depending on your exit strategy, rents, resale value, and then really trying to have a good handle on whatever your opportunity costs are going to be, acquisition, rehab, if it's a fix and flip, or the holding costs, if this is going to be more of a rental or a long-term hold. So start from the external factors, the area you're looking at, pass any kind of go-no criteria that you need to set for yourself, but then really get into the asset itself and understand what your costs versus upside is going to be.
Would you recommend visiting the assets?
You
physically going there?
I think you learn a lot by getting boots on the ground. But again, maybe it's a good bringing it back to the partnership concept. Like I say, I'm based in Houston, but actually a good amount of my portfolio is based down in South Texas. We put 28, or we're putting the last 12 of 28 units in Harlingen, which is about a 5-hour drive for me. So I'm down there periodically, but obviously this is not every week. But I've got a general contractor I use and other investors based down there that I can partner with. So for me, it's not an absolute. You have to you have to have boots on the ground. But if you personally can't go there, you must have a partner that you trust that is there. I certainly wouldn't advocate committing funds to something blind, let's say.
Yeah, I also appreciate the partnership. Like the deal in March, we actually closed it.
Okay.
I'm personally involved as well, and if we don't have a partner in the area who can do the flip and actually build out the area, she actually drives by the property. The property is on the highway, like at least once a week, so she would see the seller is now packing up and moving out. We just closed earlier this month, and just kind of seeing the progress of the property is really nice. So I always say, and also a couple of other deals that we're evaluating. I'm good at certain things, but I'm not good at so many other things. Like rehab, for example, is a big part of what I don't understand, and I hope to learn that. And I think the best way to learn it is by doing the deal through with somebody who actually have that skill set and kind of can walk us through it. So I kind of hesitate to get into a deal just all by myself these days.
Yeah, no, I fully agree, and I would say it's always good for us as real estate investors to also learn from look across other industries. And again, I talk about oil and gas. That's where I've spent a lot of my time working. No one, the big operators, the Shells, the Exxons, the Chevrons, they don't get into projects on their own as well. They partner and syndicate as well. They diversify their risks. So, and again, many other industries you can look at where the same thing happens. So, we as real estate investors should learn from that, recipe for success, and bring whatever skills or whatever your expertise are, bring that to the table and push to be, fairly compensated for that, but not to be too blind to our own maybe weaknesses or areas where others can do something better. Rehab is a good example.
So Daryl, last time we talked, you were telling us about this deal in South Texas, the Rio Grande Valley, and you kind of participated in the deal as a partner. Can you tell us a little bit about that deal?
Yeah, no, I can, Steve. And actually, we just closed a couple of days ago, so
Hmm.
that was great. And no, there was another investor who'd found the off market lead. This was as they often are. The owner had run into trouble and was about to lose the house in a matter of days. They needed, I think it was 35K or something to reinstate the loan sub two and move forward. So this thing was running to the wall and it was going to go to auction. But luckily I found out and I said, yes, look, I can help. Let's put together a joint venture reasonably quickly. We reinstated the loan and then moved through closing. There was some, as there typically are with these type of pre-foreclosures, there was some hair on title. There were some liens that we had to work through and get removed. We started that with the title company, who, by the way, did a great job on this transaction. And yeah, we were able to market with minimal rehab, find a seller, and work through closing on their side. Actually, this
Hmm.
turned out being an assignment in the end. So
Hmm.
assignment from our JV to the end seller to keep the closing costs down. And yeah, we our total cash commitment, including the loan balance plus cash to reinstate and carry the debt, was about 150,000. And the JV got our cost recovery back, plus in the range of about 60K. So you're talking 75% plus margins over 5 month intervals. So that's a particularly good one, I would say.
Hmm.
If every single deal was that lucrative, we'd all be very happy. But for me, the reason why it's a good example to bring up is it was all about partnerships. There was, no one party on their own could get the deal done. The investor that found the lead wasn't based locally, also didn't have the inclination to put the cash into reinstate. The boots on ground investor that managed the project, if you will, the rehab, the resale, had the inclination to get the deal done, but his capital was constrained and tied up. And I came in and solved the capital problem, if you will, and brought some governance and oversight. So really, when you put that together, it was a tremendously successful deal. And I think it really underlines the fact that when someone's got an opportunity or got a lead, open up to trusted partners, and that's the way we solve problems.
And and Daryl, you talk about kind of the three parties. The one that brings in the deal, right?
Yeah,
The focus is more on the marketing side,
right.
and interacting with the owner and putting it under contract. There's a lot of back and forth and coordination throughout the course of this deal to make it happen. And then we also have the general contractor or the boots on the ground, like you said. Their skill set is more on managing the project and working with the contractors and
Right.
getting the actual deal done. And then the capital guy and the finance guy comes in, and I find that the role also, you said it really well, bringing the governance and the structure
Yes.
of the deal. How does the team work together? And I think uh, it takes a particular personality to do well in for each role.
Yeah.
And we can do all. We just gotta wear a different hat and like change our mind to do well in
Yeah.
that particular role. And it's much better to have a partner that just kind of wears that hat, and that's just the way they think. And you're much more efficient, more effective when you just keep the same mindset. And I can see, Daryl, your personality is more kind of intellectual, structure, and kind of the finance structure side.
Yeah, yeah. I think that's probably maybe the way I think a little bit. Yeah, absolutely. I mean, I can, you know, work with GCs and manage that, but I think it's probably not my specialty. And also, I think all of us have, maybe a passion for certain parts of the
Mm.
sector. And you know, if you find something that you enjoy doing, and I do enjoy, you know, brokering deals and getting things done and connecting people, that, you know, I enjoy that. You know, lean into it if you're good at it, and you know, you can have some success. Double down on that, and pour your effort and energy into. That's you know, maybe a piece of advice I would give to anyone listening out there. It's worked for
So
me, I would
maybe
say.
maybe we should talk about a little bit of that role definition, or kind of the responsibility for the three roles, because I think, you know, now that we're kind of going deeper into the partnership, I think kind of clearly defining that when you first walk in, especially if it's a partner that that who may not be familiar with this kind of structure and setup. I think that's crucial, kind of coming in, so everybody knows exactly what to expect from their partners, and also what they need to bring to the table.
Absolutely. And you know, there are different ways of structuring these partnerships or collaboration. And you know, I've worked with different ones depending on the situation, be it a syndication, like an SEC 506B syndication. People will often talk about that's how we took down our multifamily project in Harlingen, the duplexes. Or you know, some maybe a bit more complicated, a bit more involved, takes a lot more time. You know, a syndication, sorry, a simple joint venture, where one party, you know, owns the asset, and then they, you know, there's a fairly light but an important legal document, the joint venture agreement, that's
Mhm.
put in place, and governs, you know, who brings the money, who does, you know, describes what work is done. I think these are all tools which are, they sound big and scary and inaccessible sometimes to people, but they're really not. You know, I think it's important that, you know, an attorney and you know, if that's in-house with a title company, then that's advantageous. But stay close to, you know, a trusted real estate attorney when especially if you're leading and putting together such a partnership. But
Mm.
no, it's once the principles are in place and drafted up and documents are executed, that effort up front to put these in place really helps in the execution, because there, you know, we are describing who's doing what, you know, who's bringing the money for a rehab, or who's finding debt if you need debt, or who's doing the accounting. There's lots of, they sound, some of them important, clearly, some of them sound trivial, but if they're not all done and done at the right time, you know, things can kind of go sideways, and it brings a lot of friction and stress into the deal. So very,
So
very
so is
important
there
to have the
so is
documentation there.
there like a checklist or a template, Daryl, that you guys follow to kind of make sure all the boxes are checked, you know, in your partnerships?
Yeah, exactly. There's a series of, I mean, most investors have probably got their, you know, their toolbox of draft or template documents. I certainly have,
Mm.
depending on what groups, you know, or investor networks people might be in. There's a lot of good ones out there. Again, pick a good or a well-known title company for your
Mm.
transactions, and they're also a great resource for some of these documents. But I mean, for me, if we just take it back to first principles, though, it's who's bringing the deal, who's executing the strategy, the project management, and then who's financing it, who's bringing the money, and I think it's helpful to keep them discreet. Not to say that someone can't take on multiple roles or do part of one and part of the other, but you know, when putting a partnership together, you've really got to think super clearly about that. You know, what is the deal? What are the terms of the deal? How are we going to exit it? And then who's going to actually do the work? Um, and then where does the money come from? How much does that money cost? What are the terms? You know, what are the risks? And really think along those lines. So in terms of a checklist, I would really start from there.
Mm.
And then once you understand maybe the risks in the project or how it's going to execute, then you can dive into the toolbox and say, okay, these are the um, these are the bits and pieces I need. Is it a JV? Is it a straight construction loan? Is it do I need to put an LLC and syndicate? Bring in equity partners. So yeah.
So Daryl, we got an audience question. I think that's like a really good time to bring up that question. What would be like a good guide to finding partners? How do you know who to work with? And
Yeah.
what are some criteria you would use?
Yeah. Great question. And I mean, let's be clear. This is one of the biggest risks. If you pick up a bad contractor, or they let you down, or don't fulfill their part of the deal, you can really evaporate profits very, very quickly. I think there's nothing. There are two things. Referral from someone you trust is super powerful. I would rather take a slightly more expensive contractor who has been referred to me from someone that I know and trust than someone that looks good, presents themselves as being able to do the deal but doesn't come with a referral. So I put the referral as very, very important. Track record, probably secondarily. But I think the third thing is, and this is easy to miss, but it's very important. What's in it for them? What's in it for the contractor? Are they going to be successful? Are they going to be making money? Quite often you'll get a painter that can come in and say, yeah, I can do the whole thing. And he or she is overextending themselves. That's not a good contractor to use. You really need to be confident that the person has done this type of work before, can be trusted to deliver on your project, and they have an incentive as well to work to get the job done. There's no sense in selecting someone that looks cheap, looks like they can get the work done, but they're also having to stretch themselves and find others to partner with them on the backside, and brings more risk into your project. So really make sure that they're referred, you can trust their track record, and that they have an incentive, that they have a route to make money as well, and be successful. Because if not, they're just going to cut corners and put your project to risk.
That's a really good tip. What would be some example of an incentive that you kind of structure to create that incentive?
Yeah, there's a few. I mean, what I've done in the past for some contractors is say, okay, fine, I'm going to assume that when you bring a contractor in, you've set a scope of work, everything's written down, you've got quotes, you spend the time to go to a high level of detail. That's an absolute. But you can also say, depending on how you're financing the deal, but quite often you've got carrying costs, either with a sub-2 loan, or you've maybe taken out a fix and flip loan, and so you're paying interest on a regular basis, right? So maybe give them a bonus if they can complete the project ahead of time. Agree up front what the schedule is. If it's a 10-week rehab or an 8-week rehab, and they get it done a week early to spec, and you verify the work's done, give them a bit of extra money. You're going to be saving that money anyway with less carrying costs and an earlier exit. So give them an incentive to get the work done fast. This is a simple trick. I use the word trick, it's maybe the wrong word, a simple mechanism, but it incentivizes everyone. You, as the investor, you leading the deal, you want to sell for the highest value as fast as you can and make the most profit. If you're just paying a contractor based on the work done, really they're not aligned with that objective. Really what they want to do is get the work done and keep themselves busy. Sometimes when a contractor sees a project finishing early, they're worried about, okay, what's next for me? Are they really incentivized to work at the pace you want them to? Well, if you can maybe put some extra money in their pocket and share them some of the extra profit you make from finishing early, well, then that's a good way to keep them fully aligned with your objectives.
Another example that I could offer is this deal where we negotiated a 30-day move out after closing with
Okay.
the seller. And initially, because the deal keeps dragging on. It took a while to close, some like extra 3 weeks or so, and the seller has to fork up an extra mortgage payment in order to stay updated before we close. And so instead of getting him reimbursed at closing, which requires us to bring more money to the closing table, what we negotiated is that they will, when they move out at the end of those 30 days, they'll get compensated back, kind of like a move out bonus.
Right.
And so that also helps with, in this case, incentivizing the seller to make sure that they are right. They move out on the day that we agree with, and that there's a piece of bonus that ties to that.
Yeah. Nice. Yeah. No, I think anything that can keep all the parties in the project aligned and pointing in the right direction is gonna lead to success. It's when people get misaligned incentives that it can get a bit complicated.
And I think that, Daryl, that's it comes with experience and kind of maybe learning from other people's experience and case studies too.
Yeah.
And just through the kind of the first half of this session, what I'm seeing, Daryl, is that sounds like there's financial modeling or like partnership models. There are different types of models that we can potentially kind of rely on, depending on what type of deal it is. Maybe it's a syndication model,
Yeah.
maybe it's a 2-partner model, maybe it's a 3-partner model. What does that kind of look like? I would personally be interested, and I think our audience would be interested in kind of seeing how to kind of set up the deal so that we're set up for success. And then another one is kind of setting up the incentivization for folks, because I know that partners, we are incentivized by profits at the end, but then all these other people that we're working with, how do we align everyone's interest? And I think especially for those that are kind of new in the game, it's basically how we want to play the game so that everyone everyone is kind of heading in the same direction. And I think that there's a lot of complexity that we could use some concrete examples on. And I think, Daryl, you have a lot of deals that you can kind of use as case studies to talk about.
For sure. No, absolutely. And again, maybe I'll bring it back to, there's 3 main buckets or 3 main areas for a good real estate transaction. There's the people that are going to do the marketing, do the legwork, bring the deal to the table, negotiate with the sellers, get everything lined up. It's even like bucket number 1. And then you've got the people that are going to execute the project, do the rehab, work with realtors to resell or list, or however you want to list that way. And then of course there's the other bucket, which is the finance and governance side. Those, trying to keep that a little bit discreet and clear who does what is important. Now there's if you like, a second level of stakeholders that are really important, and actually you could say get the work done. So then you're starting to go into your roofer, your electrician, all the different levels below the subcontractors. But also you're getting into real estate agents. If you want to use real estate agents, I like to on the resale. I think it saves a lot of time, and you can help get a better access to safe buyers, if you will, people that aren't going to let you down at closing. But title companies as well, and these are the stakeholders where really you want to. I wouldn't be bringing them in some sort of JV or any kind of partnership. You really want to keep them kind of arm's length, but again, incentivized. And their incentive, these important stakeholders, it's your volume or your consistency, the number of deals that you can do, the volume that you can bring. So if a title company knows that, hey, you need some documents drafted, or you need title commitment out today, and they're going to shuffle your file, up their priority list. Well, they're going to do that because they know that close this deal, and then there's another 2 coming right after that. So I would advocate for finding the stakeholders, let's say the tier 2 stakeholders, and work with them consistently, and be, have good lines of communication with them, and stay engaged, so that when you get a service from them, a paid service, you actually get the best version of their paid service. So I think that's very important. But again, it's really understanding who's bringing the deal, who's executing the deal, and who's financing. I mean, just always try to boil it down to that, those first principles, and then go from there.
And so usually when we talk about syndication for like a bigger deal, that's usually the finance guy that is kind of putting all that together, would you say?
Generally speaking, yeah. Generally speaking, it is. And again, for if people are listening and they say, "Well, I'm not in that bucket," or I don't want to take on that role, no problem. But when you are talking to someone like that, always keep in mind, what's your skin in the game. If you say, "Well, look, I'm going to be marketing the deal," quite a lot of people. It's a great entry to the industry, where you say, "Well, I'm going to do the legwork. I'm going to buy my subscription to Real Estate IQ, and I'm going to work all those off-market leads. I'm going to run it through my CRM, and then I'm going to try and flip and try and wholesale." I like that model, by the way. That's great. That's a good idea. But an alternate view is where you say, "Well, let's keep some element of cash, so you can come in, instead of just flipping and wholesaling a deal that you don't maybe have the bandwidth or the capacity to take on yourself, offer up to partner with other investors and bring some element of cash or some skin in the game with you as well." That shows a lot of commitment. And if when you're dealing with people that are going to bring the cash to close a deal, they have a lot of more confidence and trust in you if you say, "Hey, I'm bringing this lead, and by the way, I'm bringing some money as well." It doesn't have to be 30% of the deal. It can be just a few percent, but something that shows commitment. That's a great way for someone that's bringing the deal to sort of elevate themselves and put them in a much stronger position in the partnership.
Like that. That's fantastic. Thank you for the tip. So let's see. We got a couple more minutes, and then we'll open up the floor for everyone else's questions. So let's see. Daryl, what deals are you working on right now that you're either looking for investors that want to participate into, kind of in a passive manner, or how can we help you?
Okay, very good. So I'm always on right now. We're actually, as soon as we finish here, I've got to get back in contact with some of the partners on a closing tomorrow. This is in Brownsville. This is a fix and flip, very similar to some of the other things we've talked about. I'm also partnering on a rehab in Houston via JV there. I actually brought some money to finish the renovations. But really, what I'm looking for are these leads, these motivated sellers, where either for a medium to long term hold, or a fix and flip, but where someone needs some help putting the closing together, maybe finding debt and or equity to close, and someone that can help, someone that maybe needs some help putting the structure together, and making sure the paperwork is done, ensuring the title closes correctly, negotiating on behalf of the partnership with all the other stakeholders. So anyone that is thinking of putting something under contract but is not sure how they might exit, how they could exit, reach out and get in contact with me. That's what I'm certainly looking for. Another area, and again, this may not be the audience in your calls, but on the multifamily in particular that we've done quite often, these first 28 that we've built have been put together with construction loans. So the interest rates, let's say, are they're okay, but they're not great, typical with a construction loan. So there, it's a question of refinancing with an agency loan, Freddie Mae, Fannie Mac, and or bringing in private investors, or let's say non-oil and gas investors. Really, when you talk about a secure, a stabilized piece of real estate, in my mind, you're really started to compete with backed treasury notes or bonds even. So right now, a 17, 18-week note federally backed will get about 4, maybe maximum 4.5%. Even if you go up to 2-3 years, the interest rate's not going to change much. And there's already a big spread between what you might get at best out of a construction loan, 8-9%. So bringing in investors that want to, pay down a portion of, say, a $1.5 million loan at, say, 7 or 8%, that's also an attractive way. And again, these are the type of things we're getting a bit into the sort of the nuance and fine tuning of the project, but it's very, very important. If you can bring cost of capital down on $1 million, $10 million, whatever the size of the deal is, by 1% per year, that's significant. And that's how, as an investor or as a partnership, you can differentiate and bringing in other investors who are maybe not already exposed or wouldn't ordinarily think about real estate, but explains to them that, look, you can take the $500,000 that's in your 401k or whatever it may be and direct that and put that into real estate and maximize your elevate your returns. So that's another focus area for me, I'll say, at the moment, bringing non-oil and gas investors into real estate transactions.
I appreciate that, Daryl. And as we kind of started getting into the deals and bringing deals to our clients around August timeframe, and I'm kind of in the learning process too. And what I find is that the first thing, obviously, is how do we get a hand on the deals, right? So marketing, lead generation, and closing is kind of the first kind of hurdle. And then very quickly we realize that in order to close a deal, financing comes into play. However, whatever source of capital it is, and there are different costs of different types of capital, and there are different types of capital that you can leverage based on where you are and what the lenders are willing to lend at, and their preferences. And there's so many different types of money that we need to be aware of and kind of leverage is like its own field. And having a partner who is well versed in that and understand the process is tremendously valuable.
I think so, because and again, please don't make it seem like I would knock anyone that is a cash or a lender and is going to charge in the teens. That's great. These are super important stakeholders. They ensure a lot of deals get done. But quite often we find ourselves in a situation where we have to pay that type of amount on the cash to close a deal because maybe we don't know, or we haven't looked in some of the other areas to get great sources of income at significantly cheaper rates. Again, I would challenge everyone on this call to maybe go and find 5 to 10 people they know that have got upwards of $100,000 in a 401k. That $100,000, depending on the terms of the 401k, it can be directed to lend into a real estate venture. Again, consult a CPA, consult an attorney. There are certain criteria and qualifications to meet, but generally speaking, this is a big source of funding that can often be captured. And then here you're talking in mid to high single digits interest rates. So it's just as an example, but it is important to partner with people that have got these kind of experience and different perspectives that can help ultimately bring the cost of capital down in the project, and not always just have to go to a hard money lender that's going to charge 3 points and 14%.
And anyway, I have some stories to share, but maybe it's not in this forum. Let's jump on to our next segment, which is your Q&A with our audience. Let me pick and choose a couple of questions. I saw one that was intriguing. Grant is asking, I heard syndication works better than rentals. Do you suggest wholesalers get into syndication?
Syndication works better than rentals. Yeah, it's the great thing about wholesaling is it's fast. So you get your return super fast, and you move on, and you keep rolling. So I think it depends on someone's preference. Wholesaling, you're also kind of capped per deal. So if you see an opportunity where you think there's actually great upsides in this, well, why give all of that away and wholesale it? Stay with the deal. Take some time to get into a partnership, or bring in the funding yourself to take it down, and then back the analysis that you've done. I mean, no wholesaler would be doing what they're doing if they didn't understand the life cycle of the project and what an eventual exit would be for someone. So yeah, I mean, I would challenge people to back yourself. If you think you've got a good deal, don't just wholesale it. Bring in partners, bring in what you need to get the deal done, but share in the upside. So I think if it's answering your question, Grant, my response is, where you've got a good deal, back yourself, stick with it, get into a syndication potentially, rather than just wholesaling a good deal away.
And so with that, in that case, Daryl, a specific question I would have is, how much would, say, a wholesaler, let's say they want to stay with the deal, and then we also have a contractor and a money guy. How much would the wholesaler need to come in order to, say, do the one third cut, or what would be kind of the
Sure.
proper percentage that's fair for everybody and incentivizing for everybody?
Yeah, I mean, everything's a negotiation, isn't it, Steve? But I think one third, if someone's just bringing a deal, someone's doing the projects, and someone's bringing all the financing, that's, at least for me, that wouldn't work. I think you've got to be more, again, I hate to put fixed and firm numbers on things, but 10 on the lead generation, wholesaling with no cash, depending on the complexity, 20-30% on the project management. And then obviously, if someone's bringing all the cash, then they're going to want at least the 60 to 70%. But again, all these things that I don't want to box anyone into certain ideas. At the end of the day, everything's a negotiation. But ballpark figure, I'd say in that kind of range. So
that's interesting.
if you're a marketer and you've got a lead, and you bring an outstanding opportunity, and by the way, you bring some cash. If you say, there's half the closing costs, or all the closing costs are covered, and we just need the purchase price or the sub two, whatever that may be. Then you've got a platform to go and say, well, I need 15% on this one of share the profits.
I see. Okay. Let's see. Do people partner within the first bucket to bring the deal to table?
Yeah.
Do they do the reach out to sellers, follow up, and all that?
Yeah, great question. And again, we're talking 3 buckets: the lead generation, the marketing, the project management, the financing. But within each bucket, there are different layers as well. And we talked about stakeholders on the project management, like a title company, a realtor. Definitely on the marketing side, and this is where, again, real estate IQ is a good example. There's so much data that comes from your platform. If you're an active, a busy, a professional wholesaler or a marketer, you're probably already working with, or if you're not, you should consider working with a virtual assistant or a cold caller, someone that can help you. So, I guess to Mariez's question, yes, absolutely. Within that first bucket, time is money, in particular in that one, because you've got to get through a lot of cold calling or a lot of legwork. So, bring in a virtual assistant, or if you're not already using, use one of these online CRMs, customer relationship management tools. These are really, really helpful, really powerful ways to get through all of the communication and outreach that you need to do. So yeah, definitely a partnership within that bucket is possible.
How about this one? Which type of lead do you find most useful?
Mm. You know, you you can't get away from pre-foreclosure. You know, so the homeowners got into a bad situation. They've had several rounds of notification, and then the foreclosure date's set. So when you contact that homeowner, you can say, and it's correct, that look, if you do nothing in 21 days or 14 days or whenever you call them, you will lose your house. This will happen. So just for that reason alone, the motivation level from the seller becomes extremely high. So you can't, in my mind, you have to start there. You have to look at those. But working backwards, if we talk foreclosures, to the notification of substitute trustee, this is a wonderful list. Again, the outreach and the initial communication with the seller can be a bit more complicated because maybe at that point they still feel like they have lots of options to quote unquote save their home without selling it. But you know, you can get in a lot earlier there. They've probably not yet had the volume of other investors calling them. So maybe you get some slightly fresher deals. And again, there's also some different ways you might approach that, working with the seller, you know, be a bit more sophisticated perhaps in the way you close the transaction. Certainly if you've got hair on title, you've probably got some time to resolve that rather than just paying it off at closing or trying to delay the foreclosure. So I like the notification of substitute trustee list. And then, you know, it depends on your I suppose your motivation or what you feel about the different types of situation. Again, some people, you know, probate list, you're dealing with people that have had a death in the family, or you know, it can be a very challenging situation. Divorce court as well. Again, these are all motivated sellers, very productive. It just, do you feel comfortable talking with people that have just gone through a divorce and are looking to slice up their family estate? So they're all very good lists, but I think especially if someone's trying to learn and, you know, generate skills in how to talk with homeowners and close leads, get deep into the pre-foreclosure list, because that's where the volume is and that's where the motivation for the seller is high. Once you feel very comfortable and competent for that, certainly appointment of substitute trustee, but you know, some of divorce, probate court can be good as well if you're comfortable speaking with people in that situation.
Okay, we got a long question here. You know, new to real estate investment, do you have any good tips for investing in mixed use properties?
Yeah, mixed use. It's not one that I've got into myself personally. You know, I like you know, multifamily commercial, long-term stability. The size of the deals are larger. I just think this is, you know, again, for me personally, I'm really looking forward to build a platform not only for myself but my family as well. So that's why I stick to those for the long-term growth, and then the profits and the margins from single family. But absolutely, if you're you know, if you can find, if part of your strategy for a larger multifamily is to generate extra revenue through a cafe or a gym or a laundromat, whatever that may be, then absolutely that's a great option to take. You know, the other sort of things to look at is tax incentives or through things like the Inflation Reduction Act, Green New Deal. There's a lot of things to look at there. Solar panels on new builds, or electric charging stations for vehicles. You know, these are all options that you can look at as well, to go beyond just number of doors, square footage, you know, dollar per square foot. You know, look for other ways to generate additional revenue streams for your rentals.
Thank you, Daryl. So our time is almost up. Do you have any kind of parting wisdom or last words for our audience before we invite you back for another class?
No, I mean, first of all, Steve, thanks so much for having me on. I love what you guys do, Real Estate IQ. The data that you guys put out there is so powerful, so useful, and everything else that you're getting into with these webcasts, these training sessions, and again, actually bringing deals is wonderful. Again, just for me, I think what's really important, not only in real estate but in life, is do everything with integrity and trust. If you don't have that, you're always going to be at some point constrained into how successful you can be. That's a belief I have. But really use the data and the technology that's available as well. Real estate's about volume, and the more you can do, the more you can understand what's available, what's out there, and churn through the numbers, churn through the deals to find the good ones. That's how you're going to be able to ultimately maximize your profits. So that would be my my sort of closing thought.
Thank you, Daryl. Appreciate it. Thank you, everybody, for joining us. I'm sure a lot of you will be catching on the recording as well. Just a heads up, next Thursday, we have another AMA with another deal winner. And so just stay tuned. And Daryl, I'm going to give you a call after this. We got a couple of deals I want to talk to you about.
Okay.
And have a good rest of the day, everybody, and enjoy your holidays. Bye-bye.
Thanks, Steve. Thanks, everyone. Happy holidays.
Bye-bye. Thank you.